everybody. This is Bob Iacchino from Path Trading Partners, along with Mike Arnold as always. Quick path chat for this morning, February 16th, covering equities. Really just going to look at three of the indices, the Russell, the S&P, and the NASDAQ. Mike might comment on the Dow, but he talked a lot about the Dow yesterday. So if you want to know Dow levels, you can look at yesterday. And Yahoo, interesting story in Yahoo. Real quick before we start, on your screen right now is from the CME Group, and it is the likelihood of a March rate hike, which actually fell. I'm going to refresh this and see if it's changed while we're doing this live. It has not. So yesterday it was 31% probability, and today it's 22.1. The way this works is this is the current rate. This is the probability of that rate staying the same at the end of March, at the futures expiry at the end of March. And right now that current probability is 77.9, so that means a rate hike is 22.1, which again dropped from yesterday. It was at 31%. Some of the stuff that came out today, just in the daytime session, I went over this in detail on the FX path chat, which should be posted already. And we have housing starts came out lower than expected, 2.6 versus 0.1. Building permits were up though, which is sometimes a seasonal thing as the weather gets warmer. Initial jobless claims came out at 239,000. That was a lot lower than expected, but the continuing claims came out slightly higher than expected. And the Philly Fed business outlook came out almost double last month's and almost triple the forecast. Came out at 43.3. It was expected at 18. Last month's was 23.6. Last thing I want to say before I turn it over to Mike to again show you what's actually important. As of yesterday, we now have 90 days in the S&P without a 1% or greater drop. That's approximately 4 days short of the 2006 record. The record is 94 days without a 1% fall, but we're at 90 right now. Today would be 91, so that's kind of a big deal. That's the record of the S&P rising without a 1% or greater drop. That's a big deal. That's what we call parabolic, and that's something to pay attention to because these things tend to, at some point, at least temporarily correct, so you might be wanting to watch for that as we go forward. Let me turn it over to Mike to what really matters, which is the charts.
Okay, thank you, Bob. S&P up here right now, S&P E-mini futures. Just want to update levels for people. We're getting a lot of requests for updating levels, so that's what I'm doing. If we get a pullback, my key levels are 2340, then 2329 are the two pullback levels that could be in play right now on the S&P E-mini. And if we turn and run higher, the next level higher is 2362. Right now, just for context, we're trading at 2343. So we've been pulling back. So the next area of support is about three S&P points lower. On the NASDAQ, I had to redraw our channel lines. The resistance line had to get shifted up, and that shifted the target line should this ever trigger. But the next pullback on here is right around the 52.55 level, which is interesting enough coming right in play with the 8 EMA. So that's the level I'll be watching for a pullback in the NASDAQ. And if we go higher, I'm looking for 53.70 as the next level up. Russell, people are asking for some Russell levels. So Russell, we have a horizontal channel breakout levels on this one, and the key levels, we're already about just over 40% higher, but if it continues up, we're looking at the 1407, then the 1413, 1418, 1423, and finally 1428 should we continue higher. If we pull back, watch for 1397, 1392, and we have the rising 8 coming in, and we also have prior resistance becoming support. So you have a lot of support should we get more than a little short-term pullback, should it be a pullback that lasts more than 1 day. Finally, we've talked a lot about doubles on our path chats. And this was a weekly double. I've been asked a few questions, and I know Bob's probably been asked this. How long do these take to complete, especially some of your weekly patterns? This was a double in Yahoo on a weekly basis that actually triggered last March. March 2016, week of March 28th, it closed above the peak. It reached its first target on August 15th of last year. It finally reached its full target this week. I think they announced news with Verizon that there was a renegotiated deal. They renegotiated the purchase price for Verizon buying Yahoo based off of, the hacking email scandals. So they think they negotiated a bit lower, but that finally drove it to target on the weekly basis. So that's just under a year. It took this whole pattern to play out. Just wanted to show people that it does not matter how long it takes. It never came back to stop us out, because after we hit our first target, stop went to break even, and it never came back to break even. So now that pattern's complete. It's off the table for me, and we're done. I'm turning it back over to you, Bob, for any additional comments you have on that.
That might bother a lot of people that something like this took almost a year to complete, but it doesn't bother us, because the one way we always look at it is, did you make more or less money because it happened faster? You may think, well, if it happens fast, I can put that money to work. And that's somewhat correct, unless you use dynamic scoring in your risk management, in which case it again doesn't really matter whether you close a trade out or not. So we use monetary-based percentage of capital at risk management. And when you allocate capital to a trade, you keep that trade to completion. That's what keeps your back testing relevant. PathTradingPartners.com. Again, last week's Money Path podcast is still up. We'll be recording a new one on Friday. We'd love it if you would subscribe to that. Click the subscribe button on these videos on YouTube, and follow us at Twitter and Facebook, PathTradingPartners.com on both. Thanks, everybody, and we'll talk to you soon. Cheers, Mikey.